Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Monday morning edition of Benzinga's Pre-Market Prep. I'm Spencer Israel, as always, joined by Joel Elconin and Dennis Dick. It's going to be the start of a jam-packed week. We got earnings coming out the kazoos. Not so much today, but a lot of big ones on the docket for the week, so we're going to talk about that. HIBB looks like it's going to drag down to retail this morning. WebMD's going private. We have got a Fed meeting in the middle of the week. So we'll cover all that and more. Two guests on the docket for today. One is live, the other is recorded. The first is at 8:35. Kenny Polcari, he is a director of NYSE floor operations for O'Neill Securities. You also may have seen him on CNBC as he's a contributor there. And then at 9, I'm going to air an interview that I did last week with Jim Riccitelli. He is the co-CEO of Unison. They're sort of a home equity company, so that'll be airing at 9 a.m. Joel, how are you doing in the market this morning?
A little bit in the red, Spencer, by nearly 3 points here at 2466.75 for you SPOO watchers. Double close up at 71 and a quarter, 71 and a half. 2471 and a half represents your all-time closing high and overnight high right there, 2470.50. So we got a great number on the upside to look at. On the downside, too, we have a good number. Friday's low, 62.75. Current low, 63.50. Will not be any continued downside until we break that 24.62 and a quarter. And you have crude in the green here by 20 cents. Trying to get into the 46 handle. It was there a little bit up at 46.33, but still kind of quiet consolidation here in the crude oil market. We'll take a look at that on the daily charts. Also, gold and silver continue their rally, kind of a slow meandering rally north. Gold over 1250 at 1256.30, and silver up a nickel at 1650. Dennis, how was your weekend?
Not too bad. I saw a yellow duck.
You saw a yellow duck, or is that a movie?
The yellow duck, not a yellow duck. The 150th anniversary celebration in Canada. Do you know what we did for it?
Joel and I
can we rewind this? Can we start the show over again?
Joel and I don't know what you're talking about right now.
Okay, so we have a 61-foot rubber duck that they have created in Canada that's doing the tour of, well, actually, I don't know if it's the tour of Ontario or the tour of Canada, but it's for the 150th anniversary of Canada and 150th birthday, and we have a 61-foot rubber duck that we spent $200,000 on. Well, a blow-up duck. So, and it toured up to Midland, Ontario this weekend, and I boated over to see the blow-up duck, the 61-foot yellow duck. I even took pictures of it. I should send you those pictures. But $200,000 of taxpayer dollars spent on a yellow duck. Interesting.
Before we digress much further, what the hell does a duck have to do?
That's what I don't get. I don't get why it's a duck. Like everybody's in Canada saying, we got the beaver or the Canada goose, or why did we do a duck? I don't get why a big yellow duck. But anyway, somebody thought it would be cool. The kids love it. I don't know. Maybe it's a moneymaker because I actually went over to the festival too. And they were selling little rubber ducks that you could probably buy at the dollar store for $1 that squeak for $10. And every kid was walking around with one. As soon as, I got near there, I was like, holy cow, I saw the price $10. I was like, I got to get my kid out of here because I do not want to pay $10 for a $1 rubber duck. So maybe they're making money on this thing. I don't know, but interesting. So Google if you want, the Canadian yellow duck. Actually, a lot of people in Canada I don't think are pleased with spending $200,000 on something that really doesn't even, have any, national symbol or anything. Like a beaver or something would have made sense. Even a Canada goose, but I don't know about the yellow duck. Anyways, my kid liked it, though.
Good thing I don't trade currencies right now because I'd be hitting every bid in the Canadian dollar. Well, you can't hit bids. You got to lift off.
It's been hot. Maybe the yellow duck did it. Maybe it's the yellow duck currency. But I'll tell you, the Canadian dollar has been unbelievably hot here ever since they raised interest rates a quarter point. I think the first raise in 5 or 6 years here. So, and they are talking that they might raise next quarter there as well. So, Interest rates trying to go up a little bit in Canada, although I don't think they can raise them too much, not to have a whole Canadian talk. But housing prices in Toronto, I believe, fell the most last month in 20 years. So you've got a little bit of a housing bubble in Canada we've talked about for a while. But even though they fell, I think 6 or 7% last month, it's a pretty incredible fall in 1 month. When you put it in perspective, it's such an incredible run in housing prices in Toronto that I don't even think it's even close to where they could come down to.
So this is a 30,000-pound duck. It's the world's largest rubber duck. It's 6 stories tall and 89 feet long. What is the point of all this?
Well, I can't figure out the point. That's what I was arguing about too. 200,000 of taxpayer dollars spent on. I don't get the point of it. It should have been a big Canada goose at least, because it's more of a national symbol. I don't know the point of the yellow duck. I'll tell you though, the kids loved it. There was lots of kids. My kid loved it too. He was talking about the yellow duck all weekend. So maybe they knew what they were doing. The kids like it. All the adults are sitting there shaking their heads. Why is it a yellow duck?
All right. So what a great start to the show on this Monday morning. We're talking about. All right. Let's move on. For a Monday morning here, we got some pretty good action in the markets, primarily because of earnings.
Yeah, we do. And just before we jump into the earnings calendar, we got somebody that was not on the calendar reporting guidance here. Habet Sports HIBB, and it is getting rocked. Spencer, give us the results.
Well, the estimate was that they would make 15 cents in the quarter as far as EPS. Now they're coming in and saying that the Q2 EPS will be a 19 to 22 cent loss, and that same-store sales are down 10%.
That's a killer. And this is obviously a stock that has already had it rough, and now it's going to have it even rougher here this morning. I mean, put it in perspective, $30 stock in April, had a terrible quarter, brought it down to 19. It's opening up at 16, so the week get weaker. If you want to even go back further than that, in November of 2016. So we're only going back, 7-8 months ago, $45 stock. 16, so it's been cut by 2/3 here now, and this just is another retail story here. Even this thing got up, I guess, to 45. I guess it was the greatest selling opportunity. Because now you're at $16. Retail is just hurting here, down 10% in sales or whatever number that you gave. That's just a killer, and this is why stock is getting killed here this morning.
And not much to say. You just made a pre-market low not too long ago. Hit $16.50, but only a 20-cent bounce here. So no one really trying to take this thing off the mat. Former low of the move, which you may never see again, was 1902. So if you want to get a rip-roaring rally, that was the former low of the move. Now you're back at area. This is, man, if you own this stock, you're not too happy. You're trading at levels not seen since September and October of 2009, and they're traded 1682, 1675. Yeah, that's where the charts are now. I doubt that's going to be the low of the day, but we'll keep an eye on that area and kind of see where it's trading right at 929, 930. See if there's really any buying interest here at the 1670 area.
Yeah, and I think this is going to spill over in other retailers here too, especially the direct competitors. Think about Dick's Sporting Goods, DKS. That stock is trading now 5% here in the pre-market. Another chart that has just been awful. Go back to the same price in 2016, in October 2016, $62 stock. Closed Friday at $37.16. Opening today, well, at least in the pre-market here, trading at $35.50. Offered down heavily at $35.75. This stock looks like it's ready to make a new 52-week low this morning too.
And, short, long, whatever, I think the biggest perspective that we want to give on these issues is that, they're going to be down today, and they might be down tomorrow, but these stocks are just a strong trend that if you're trying to cover a short, okay, it's a great opportunity. But as far as looking for these things for long-term longs, I mean, I don't know.
Fighting the tape.
Yeah, you're
fighting Amazon. Fighting everything. I mean, retail is just it. And even, you look and you could say, okay, well, retail had a pretty good month. I mean, bring up a chart of Macy's. And obviously we're digressing a little bit here because Macy's isn't a direct competitor with Habet Sports. But, retail is all just kind of follows the same, retail, and everything is Amazon problems. But Macy's has had a pretty good couple of weeks here. We've been bouncing up a little bit here, but it seems like every time we bounce up, we just find more resistance or we find more overhead supply. Kohl's has bounced back above 10 or 15% last month. So retail has showed some life here. But, what is the reason to go jump in here into a Habet Sports or Dick's Sporting Goods when they're making new 52-week lows? I've always said when a stock makes a new 52-week low, you got to go. You don't want to be in there when they're going down because sometimes they just continue to leak. And you're into a sector here that's in a whole world of hurt. They were in a world of hurt before. They really didn't participate in the recent bounce in retail. I mean, Habet was down on Friday and only a buck off the lows where you got the Macy's and Kohl's trading 10 or 15% off their lows. So there hasn't been a bounce here. Now, you get the news, and I just don't see any reason to jump in here long either.
Just for the Dick's Sporting Goods, I see it trading at 35.5 right now, and I'm going back on the monthlies here, and you were in this area not too long ago, as Dennis mentioned. Some lows in the 33.44 handle. 33.44 was one low, 34.88. So I think you creep under $35, you might start to find little buyers. That's just based on the monthly charts. 2 monthly lows, 33.42 and 33.45, Dennis. So if it gets down there, I want you to cover your short if you have one.
I have no short on, but I wish I was short. Anyways, we were just talking to, while we're talking retailers, let's go talk Chipotle. So obviously just a restaurant, retailer, but man, the thing just keeps going down here. And it's like a repricing of it all now. Singh obviously came out with the bad news there. They had the second, incident where, obviously a lot of people got sick, the norovirus or Nova virus or whatever the hell you call it. It's lost 50 points here in the last 4 days. And a lot of people are saying, okay, well, is the buying opportunity now? I don't think so. Personally, I think you're going to have a lot of people very, very nervous here to eat there. Maybe there's going to be some arguments here from Spencer in a second, but I think if you get a good report, and it's going to report Tuesday after the bell, so it's coming up. I think if you get a good report, because none of this, virus stuff is going to be in that report, I still think that's a bounce to sell. So that's what I'm kind of hoping for, is a good report, maybe get a bounce, maybe get a couple-day bounce even, where stock can get back up into an area, and then I want to short it. But if, whatever reason they give guidance in that report, maybe it's not going to be good, because I think next quarter there's going to be a lot less people eating at Chipotle.
Well, so here's my point, and I realize that this is purely anecdotal evidence, but I was talking to my girlfriend over the weekend, and I said, hey, did you hear about Chipotle last week? Because it came up in conversation. And she said no. And I said, oh, someone got sick at a restaurant in Virginia. They had to close it down. Do you care? And she's like, no, not really. And I was like, well, would you eat at Chipotle tomorrow? And she's like, yeah. And I got to thinking about that. And I think this mirrors kind of the conversations we have about Twitter and about that stock. Is the people who care, the people who follow the news and care to follow the news, they know, and this matters to them. But for a lot of people who just don't follow news like this, just don't care. They just don't care.
If you live on a desert island and you didn't have any idea that this was going on, you wouldn't be eating at Chipotle, because there wouldn't be a Chipotle on the desert island. But it got pretty major headlines, though. It wasn't just like a stock thing.
I know, but I think you
major headlines.
You
there was rats in the other story. Did you ask her if she'd eat there if it had rats in the store?
Did you ask her that? Rats
swinging
from the rafters?
I didn't say that. I didn't ask her that part. But I think we overestimate. So we're in this news bubble here. I think we overestimate how closely people pay attention to the things that we pay attention to. She didn't know about it, and she didn't care, and I think her family is the same way. And I have a lot of friends that are the same way, that don't work in news and just don't know these things, and so they don't care.
It's a good point, but I still think this got so much major news headlines. And I just go, and you can go to you can go to the iwaspoisoned.com, or you can go there. But, if you just go on Twitter and you do a search, and this is why Twitter has some value. You go on Twitter and you just put Chipotle. Don't put CMG, because if you put CMG, you're a stock trader and you know what's going on. Put Chipotle and do a search, and you have a lot of people, talking about this incident. And those are non-stock people. Maybe they're news people because they're on Twitter. Maybe they're up, to date. But I just think, and is sales going to fall by half next quarter? No. But the one consideration is, you see what happens with Habet Sports when sales fall 10% in a quarter. The thing goes down 20% of the stock. I think, you could see sales fall at Chipotle 10% next quarter because of this incident. I think it's possible. I think the stock could, fall under $300 if that happens. So I'm just looking at it and saying I think there's enough people that paid attention to this that are going to be hesitant to go there next quarter. It means it could have some really ugly quarters coming up. That's what
That's funny, Dennis, because I would also suggest you search Chipotle on Twitter. And because if you do that, you'll see there's people that are just not talking about this at all. It's support the BHS boys soccer team by eating at Chipotle tonight from 5 to 9. It's Chipotle or Qdoba. I just don't. People don't care about this.
Well, Spencer's buying Chipotle. He likes.
No, I'm not. I just and the people.
That's a bet between me and Spencer.
The people that I'm referring to aren't even on Twitter. You know.
Do you know how long this has been? Just to interject here. Do you know how long this has been going on?
This thing.
What do you mean?
Just like
2015.
Yeah.
They've murdered some. Base.
Smugness and happy talk about sustainability aren't working anymore. Hats off to Susan Burfield from Bloomberg. They wrote this article in 2000. I mean, if you think about that, I mean, you've had a lot of warning in this thing. I mean, Dennis, you're talking about a whole number like 300. I mean, if you're looking to go long this thing, I mean, you got to wait for at least to stop going down. But Dennis, the thing that you alluded
100%.
to, I mean, you're just seeing this effect now, so it's not going to affect this quarter's earnings. You know they're going to come out. They're going to guide lower, right? And then
I don't know if they will.
No?
Because they don't really have that much on the quarter. I don't know if they will. Maybe they don't want to guide lower this quarter because maybe they don't want to guide yet because it's still early here yet, and they don't really know what we're talking only a week later.
Right.
So it hasn't really been a lot of time for them to really gather that next quarter is going to be tough. They had a bad week. They're not saying, the next quarter, the entire next quarter is going to be tough. So I don't know if they've had enough information to guide lower not tomorrow night. But I think eventually they will guide lower because of this event. That's what I'm thinking. Maybe I'm wrong. Maybe it's going to be, maybe Spencer's right. And, this is going to be interesting to find out. Maybe there's enough people that don't care about this. Maybe, sales aren't going to fall 5 or 10% next quarter. Maybe sales are going to go up next quarter. But I just saw those videos. They went pretty viral. The rats coming from the sale. They got a bad rep right now. And that's going to take some time again to repair. And they already had a little bit of a bad rep. And I just like I was saying last week, I was talking about going back and eating Chipotle. I liked it before the whole incident back there a year and a half ago. And now after the second incident, a year later, now I'm like, no, you know what? They can't get their act together a year and a half later. I'm done with them. So if there's just 5 or 10% of the people of the customers out there like me, that would be real trouble for them. So I don't think you need sales to fall, 50% or 40%. Sales fall 7 or 8 or 10% next quarter, the stock's going to get killed. And so that's what I'm just saying is that there might be 10% of the population out there that might not eat there. 10% of the current customer
right. Well, that's the question. Does 10% of the customer base are they in this news bubble with you? I guess we'll find out.
That's the question. True. There's 10% of the customer base in the news bubble too. So
and
there's a lot of questions here.
Final...
I'm betting on down. My money's on down. So and the valuation's still an issue here for me too. It's not like the stock is cheap on a valuation.
And what about attracting new customers? They're worried about keeping the guy. I mean, how many new? They're going to go to what's that? El Doro Taco. What's the other one?
Qdoba.
Yeah. I mean, they're going to those places.
Moe's.
But
Del Taco.
Joel, you're kind of on the sidelines here. What do you think?
I told you I ate there once 5 years ago, and I didn't like it.
You never liked it.
Yeah, I never went back, so I'm not a good...
We've never liked Chipotle really on this show.
Yeah, but anyways, it's showing a little life here. Closed week, 343.90.
Life? Where is this life you speak of?
Well, it's not going down.
As a day that's not going down, Jules, this is showing life. That's awesome.
All right. Well, we'll see what happens. I know. Spencer, you want 400, or I bet you Dennis would even give up the edge. He would give you.
I would. You know what? I'll take 300. Well,
he'll give you 390, and then he'll take 300, and then he's giving up a little bit of an edge there. What do you think?
And then the quarter would probably
345. He's giving up a little bit of an edge.
I think it could pop. I think it can pop tomorrow night. So, this is why, I've said, because I don't think this is going to be baked into this last quarter's earnings. I don't think they're going to guide lower tomorrow night. So if they have a good report here, it's okay. But people aren't going to be thinking that, no, but none of that's baked in and the guidance isn't good. So I'm hoping for a pop tomorrow night because I want to short that pop.
All right. Just talking about whole numbers, and this is a little bit late, but look what happened when it got to 500 in April and in May. 497.48 and 499. But you know what? 400 is going to be the new 500, and if it ever gets back anywhere in that 390, there are going to be a lot of people. That's another thing you have to think about is when you're buying the stock today because you're looking for a rebound or whatever, you got to look at all the people. I don't know if anybody's in it since it hit 758.61, but you got a lot of competition here on any kind of rally as well.
Overhead supply.
Overhead supply.
Well, okay, we haven't had one earnings stock here. We had a guidance stock. Let's jump into the earnings parade here. Spencer, where do you want to go? We got Hasbro, Halliburton. Where do you want to go?
Let's start with Halliburton. They reported there this morning Q2 EPS 23 cents versus an 18-cent estimate. Sales of $4.96 versus $4.86 billion. So a good Q2 there for HAL.
Stock getting a pop. Same thing happened with Schlumberger. I mean, we're a big fan of sympathy on this show. Schlumberger got the pop off their earnings just last week, but it gave it back. So here's Halliburton trading up 3% on a pretty good report, popping up right to a major resistance point of $46 though. So this makes me think that this could be one of those situations where this is going to follow oil in the long run, and you're getting a little 3% anomaly because of the earnings, but I think this could be a pop that gets sold.
Little overdone when you got to 46.46. This is around 7:30 this morning. But, man, you just need to look at your daily charts. You're under $46 right now. And just look at those daily highs there. You had your 2-day high right at 46.10. And then you go back a couple other tops in June. So 3-4 tops in the same area, below it in the pre-market. So we'll see what happens at 46, coming back on the downside here. They haven't really hit it too much, but easier to pick out that resistance. You have 3-4 tops between 46 even, 46.22. Your pre-market high right there as well at 46.46.
Hasbro, this could be, and I have not seen the report yet, so we're going to get in a second, but what have we been saying on the show is stocks running straight up into the report, got to blow it away to go higher. I look at that chart, that has been going straight up, trading at an all-time high on Friday, closing right up at the highs, near the highs, 115.95. And even before hearing the numbers from Spencer here, I would have gambled that it probably goes down because they don't blow it away. Spencer, what was the details?
Well, they didn't blow it away. Q2 EPS 53 cents versus 46 cents. Sales about even, 972.5 versus 972.4 was the estimate, $1 million. So they did not blow it away.
Not a bad report. If the stock had the opposite chart going in, it would probably be up here this morning, meaning if the stock had been going straight down into that report, they probably would have rallied it. But again, expectations way too high for this stock here. And they've been doing the same thing. Stock charts have looked like this. They've been selling on good earnings. Earnings were fine. Doesn't matter. Stock's just been too hot, and it's correcting a little bit here this morning.
And you had a nice level to lean on. If you were looking at your June 29th low of 108.94, yeah, you just would have missed it because you had a 108.99 low and now getting a little bit of a bounce. Short-term resistance here at 112 even, so repricing, really holding that pre-market low at 108.99 is pretty crucial because you get down in the lower 8 handle, but under that, 107.12 was your low back in the middle of the June. But, man, street leaning the wrong way into this one, and then you get a report like this. Any kind of rally, I mean, I don't think we're going to get anywhere near yesterday's low to fill the gap at 14.72. But we'll see what happens now. Nice run up and then down on the earnings report.
Have you ever seen a pair, two stocks, Mattel and Hasbro, as a pair trade so opposite to each other? I mean, Mattel is trading right near its 52-week lows, really when you put it into perspective. Because this stock was 47 or 48 bucks back in 2014. It's down near the lows. Since that time, so we go back to 2014, Hasbro was 50. That was 115. Mattel was 45, and now it's 21. What happened to Mattel? Because, you'd think, okay, well, they're both toy makers. Like, I don't know the difference here. Obviously maybe one's got, is one Star Wars? Is that what it is? But what happened here? Because Mattel and Hasbro are the complete opposite charts, and they're both toy makers.
I think doesn't Hasbro have the Star Wars stuff?
Does Hasbro have the Star Wars, Spencer?
I don't know. I'm looking right now.
I think it's Hasbro, too. Maybe it's Star Wars help this? Is that a big thing here? Like, what drives Hasbro straight up and Mattel straight down? And I don't follow the sector good enough here, I'm just wondering, chat, help us out here. Why is it? Like, all I can think is maybe it's Star Wars toys and Hasbro, and Star Wars is so hot. But holy cow, this is just, if you're Mattel, what's going on? Hasbro straight up, Mattel straight down. Is Hasbro just Amazon proof and Mattel isn't? What's going on? I don't know.
Are they selling Ken and Barbie dolls on Amazon now?
So Hasbro has Star Wars and like Disney princess stuff, like Frozen.
Hasbro just has better toys,
I think.
Wow. Because Mattel and Hasbro used to trade together. I used to pair trade this back in the day, and obviously I've traded for 18 years. Glad I haven't been pair trading in the last couple of years because I'd be getting killed. Hasbro straight up, Mattel straight down. I don't know in that divergence if that ever comes back in, or if this is just a new theme that Hasbro's just the toy maker that everybody wants and Mattel isn't. I don't know, but these two stocks went opposite directions.
All right, I don't know what if we got any news, or too early for the buying balances, but the S&Ps are back to unchanged now, 24.69.50. Yeah, that's only a buck off that pre-market high of 70.50. So unchanged here in the S&Ps, a little bit of a rally going on.
VF Corp reported here this morning as well. Spencer, give us the details for VFC.
VFC Q2 EPS 29 cents versus a 28-cent estimate. Sales of 2.36 versus 2.29 billion dollars. So that's a fine Q2. They technically beat on both. As far as guidance goes, they see their fiscal year EPS at the high end of the prior range they gave as the estimate, and their sales coming in just about in line. 11.65 billion is what they see for the fiscal year. 11.60 was the estimate. $60
is the number here. It's a big whole psychological number. If I go to the book, I can see 46,000 shares for sale. The New York book at 46 as well. That's your big hurdle. Takes that out, then you can continue higher, but I think that's where it struggles right off the hop. I'd be really interested to see at 9:30 if you can take that out, but I don't know. $60 sounds big to me, Joel.
Yeah, I was going to put it sometimes I pull up a chart before you go to the next stock, and then I was going to say, Dennis is going to say he likes $60 on this one. And
by like means I like it as resistance, meaning the stock might stop there. That's the number that I like for a swing number where it could turn the other way. So it means I actually don't like to own the stock at $59.98.
Or if you just happen to scoop up along or something, you would definitely be getting that offer out in the $59.90 handle in case it traded 60.06 and came back down.
And it's traded 60 about 1, 2, 3. There's been about 10 trades there, little 100 shares trades and 1,000, a couple thousands, but it's struggling there at 60 in the pre-market, and it looks like it's going to struggle there in the regular session with that kind of size in the book.
Yep. All right, $60. So we'll see what happens if it can get back up to that level and off a decent report.
Arconic, ARNC, which is the legacy Alcoa operations there. It's trading up 69 cents in the pre-market. Good earnings?
I didn't see it come across yet. Are they scheduled today?
Did somebody jump in the gun here?
Is Arconic even scheduled today? I don't even know if they are.
I had it scheduled.
You did? Okay.
I did, and I see it trading up 3%, so I would think that's got to be on a report.
Yeah, okay,
here.
They are scheduled. I haven't seen it come across yet.
Oh. Okay, well,
jumping the gun a little bit here, Dennis.
If we haven't seen it yet, yeah, because this is a big pop here for Arconic, but I have not seen it. Wave Trace is not out yet either, so somebody's excited to buy Arconic. Sometimes it come out right at 8:30, so we'll find out. And speaking of 8:30, we're coming on to that hour here right now. Let's give you the first look at the imbalances, hot off the press. They are mixed. Alibaba, buy and balance every day. 36,000 shares to buy in Alibaba. Twitter, 33,000 to sell. Now $20 stock. It's been on an incredible run there. Lowe's, 30,000 to buy. Lowe's and Home Depot got killed last week on that Sears.
Saw that.
Yeah, which I don't even get. But anyways, General Electric, 68,000 to sell. Is a sell and balance every day. Those are the same always. That's pretty much it. They're really small.
Just going back.
What about Lowe's?
Well, before we go to Lowe's, I just want to talk about this Arconic here. And you remember you got the hit for 25 to under 22, and I believe that's when you had the big fire at that hotel in where was that? It was overseas, and it was some faulty, or they suspected some faulty insulation that was created by that company. created a buying opportunity, though. I'm not sure what's transpired from that ever since, but that was the reason for your dip under 22. Now back at 26. I see like it did trade over 26, but if you're looking at dailies, I don't know if just want to give it a hair above 26 if you get a pop, because you have a trio of highs in late June at the 26.50 area. That's where we're trading right now. So up at resistance here in ARNC.
Just popped up another 50 cents here, so I'm wondering if earnings are starting to break or if they're coming across at 8:30. But we'll keep an eye on that. We'll come back to it for you. We got about 4 minutes here left.
What about Blue Apron? Check that guy out this morning. I think the quiet period is over.
What's going on?
I think the quiet period is over.
Pop.
So we got to pop because the analysts are coming in with their buying shoes.
Are they really? Who's coming out?
All right, here's what we got this morning for you. We've got William Blair coverage. Actually, that's market perform. But Oppenheimer outperform. SunTrust buy $12 price target. Stifel Nicholas buy $10 price target. Goldman Sachs buy $11 price target. RBC outperform $10 price target. Barclays equal weight $7 price target. Morgan Stanley equal rate $7.50 is the price target, and Canaccord is buy with a $14 price target.
Doesn't sound like a lot of people coming out with sells or bearish on it. So, but how many of those were underwriters?
I would wager most.
The skin of the game here. Anyway, stock getting a nice pop here, $7.10. It's shown a little bit of life the last 4 days. It stopped going down at least, Joel. So, I don't know. I guess you could get a little bit of a short squeeze here. Or I don't know if anybody's short, actually. It's so early in it. But maybe shows a little bit of life. 8.5% up here this morning. I mean, I think you got room to $8. Above that, I think you're going to have a little tough sledding.
I want to see if it can even close over $7 today.
You think sellers can come into this?
You got a 731 high in pre-market. Backing off, I mean, you are finding buys. You're currently trading at 712. I mean, that's a whole lot of, buy signals to get this thing up 50 cents. Gap to fill, if you're a gap trader looking to fill that void in price here, 749. I'm not sure what happened. That might have been when Morgan Stanley, they did that a little bit. 750 fills the gap. You had to close at 740 on July 12th. So let's see what happens. See if it can get back and test that, fill the gap at the 750 area.
I have Arconic now if you want it.
Well, so it did come out at 8:30.
Yeah,
what is it?
32 cents versus 26 cents. Sales of $3.3 versus $3.16 billion.
And we had the pop, and we've dropped a little bit since then. Widespread right now, so 25.81 to 26.77 here. So you're looking at a very widespread. Actually, 26.50 now the offer, but so it's widespread. It's up 4% right now, but that is very wide here this morning. So just digesting those earnings.
And right into that area we talked about just moments ago, you had the trio of highs, really from 26.40 to 26.60. That's where we stop for now. So let's see if we can find some buyers, get into the 27 handle.
They're also raising their sales outlook, and they're increasing their the low end of the adjusted EPS guidance.
So some good news out from Arconic this morning. I like fuzzy comments. Dry ships to the moon.
Yeah, did you see that?
Not to $20 million a share, but it is up 17% here this morning, and it had a wild range on Friday. It's not a day if we don't talk about dry ships. It had the ridiculous, three. So it had the 7 or the 1 for 7 or whatever reverse split, and the adjusted close was like $3, and it opened at $1.50. Well, I tell you what, in the afternoon, the stock took off and actually got all the way back up over $3, almost to $4. So you get a little bit of a short squeeze. We know these things can happen. And then it sold off $1.50. Wild child. This thing has like a 30% range, it seems like, every day, often the 20% down. But today we're going the opposite way. We're up 17% this morning. Can we squeeze those shorts a bit, Joel?
I reserve comment. I'll let you comment on this stock, Dennis.
You're done talking.
You're the expert on dry ships.
No, definitely not. I'm the expert on dry ships.
All right. Well, we can put dry ships off until tomorrow because it's 8:35 now. We got to go grab our first guest, Kenny Polcari, Director of NYSE Floor Operations for O'Neill Securities and a frequent CNBC contributor. We'll be right back.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elconin, along with Dennis Dick, Spencer Israel behind the glass. We have Kenny Polcari on the line, Director of New York Stock Exchange Floor Operations for O'Neill Securities. How you doing today, Kenny?
I'm good. How are you?
We're doing good. So, summer markets, light volume, people taking vacations. I think, don't people say that Europe takes all of August off or whatever? So,
They do. They do. And if it gets any slower than it is, it's going to be horrendous the month of August. But remember, during these summer months, when the volumes are kind of low, typically you get exaggerated moves, which, you have to be very careful about just because of lack of participation. I think a lot of the large asset managers who, are taking time off or go away, straddle the market on both sides. If the market trades off X percent, they're there with plenty of buy orders. If it trades up X percent, they're there with some sellers to try to lighten up. Anything in between is really just noise, and so you won't necessarily see a ton of action coming from the big institutions. You'll see it very much a trader's market. Really kind of a trader's market and kind of a high frequency market, which is why you see kind of decreased volumes, right? This week we're right in the middle of the crush, right? This week and next week we're going to get just bombarded with earnings announcements, multiple announcements every day now going for the next 6 or 7 days. So that's going to really be the focus, the micro data, right? The individual company data. You saw that, we've seen that now for a couple of weeks. GE was the big talk on Friday. They came out, and although they beat line, they kind of disappointed going out, and so investors hit the sell button. Some of them hit the sell button, knocking the stock down another 3%. But really, that was the focus. That was really the chatter on Friday. Was GE, GEG. There wasn't a whole lot else that was causing the market to go one way or the other, right?
Right, and so just from a institutional order flow standpoint, I mean, are they cutting their orders in half, trying to work them at different times? I'm just going general here because you have the less volume.
I think listen, the way trading has evolved, right? Trading done today is not the way trading used to be done. In the 80s and 90s, it was much more aggressive. It was much more because of the popularity of passivity and passive investing, the whole kind of focus has changed, right? So yes, asset managers dicing and splicing as they're spreading out over across 10 different exchanges in 30 or 40 plus different venues, right? Alternative venues. So trading takes place very differently today. But from a long-term large asset manager view, unless there's a real catalyst that's going to change the conversation, they're very comfortable where they are. Now, yeah, we're trading all-time highs. Yes, the VIX has made an ultra-low, actually, I think an all-time low print on Friday, which causes some other levels of concern because it's so complacent. It sends a message, we missing something. Is this exactly where turns are born, right, in terms of market turns with the VIX printing so low? Are we in for rougher days ahead? Now, look, August and September tend to be difficult months for the market anyway. Going into August, September, people should not necessarily be surprised if we see some volatility and some difficulty ahead. Look, not a lot's happening out of Washington. No matter what you say, we're not getting any reforms. Trump is begging them all to stay in Congress and work on this healthcare reform. And I think the ones that are up for re-election next year are saying, sayonara, I'm going back home and I'm raising money and I'm going to be visible to my constituents. And so I think there's an issue going there in Washington that's going to cause long-term investors to think, look, this market's priced for perfection. People bought, investors and asset managers were buying stocks ahead of what they thought was going to be a massive change in DC politics and reforms. And we're now almost 3/4 of the way through the year and got nothing. So the chance is in 2017, does anyone really expect we're going to get any change or any reform at all? And if we don't, then there has to be a reevaluation, right? Maybe there's still some hope it's coming, but as we get closer and nothing's coming, there has to be a little bit of a change in value. It doesn't mean the market's going to crash. Just means don't be surprised if you see a change in valuation. And then that's when asset managers, I think, will get a little bit more aggressive in how they represent and how they're trading and how anxious or aggressive they are, either in trimming some positions and reallocating or not, just trimming positions and holding the cash on the side, which is always an option.
Kenny, Dennis Dick here. You've been on the floor a long time, and I've been trading
35 years, but don't tell anybody.
I've been trading 18 too, and I can tell you this is just a one-sided market here, where you've seen for the last 4 or 5 years, it seems like every dip just gets bought, and we've had periods of time where we've had markets before, and you can probably remember, back 99, 2000, but this seems pretty relentless. Like every time we pull back, especially in the S&P, we pull back just 1-2%. It seems like there's just this underneath demand. There's just people coming in. Is that people underinvested? Like why? Who is it that keeps buying the dip?
Listen, I think there's a big play. I think there's a lot of hedge funds and a lot of people that have been playing this from the short side that have just gotten their heads handed to them because the market continues to churn higher, and you can only play that game for so long before they bankrupt you, right? I mean, you can keep shorting and keep shorting, but the more it goes higher, all of a sudden you can't play. So I think what happens is when the market starts to back off, you get some of these guys that are starting to throw in the towel that are just, you know what, I can't take pain anymore, and I can't wait to see if it's going to come in 5 or 10%. I'm just going to take my lumps and go away, which is why I think you're seeing some of that. But you see, that's going to come to an end now, right? That's going to come to an end. And I think what's going to happen is when the market does turn, you're going to see a very swift move lower. Now, again, doesn't mean it's going to crash. Just means, don't be surprised if you see a 5 or 6 or 7%, pullback in the market, and it could happen very quickly. Could happen in a couple of days, right? You get a couple of percent a day for 2 or 3 days, and there you go. You're going to be down 4 to 6% before you know it, which necessarily wouldn't be the worst thing in the world, because what it would do is take out some of the fluff. But if all these guys are in the towel now and buying on every little dip because they can't take the pain anymore, when it comes, they're not going to have that position anymore, right? So there goes all your support. There goes all your demand. And so that's why I think you'll see the market back off relatively quickly. But yes, it has been a one-sided market. It's been, in the last couple of months, have been, honestly, with the low volume and low volatility, it's been actually a little bit boring unless you get specific issues that are the talk of the day. Like Friday was GE, right? Or a couple of weeks ago it was all the tech names when we had that quote-unquote tech wreck, which wasn't really even a wreck. What was it? 1.5%? I mean, come on, who's kidding who? But I think what you're going to see as we move into this week and next week, it's all going to be earnings, and then August and September is going to be interesting to see how the market reacts, and then how investors react.
We're on the line with Kenny Polcari, Director of Floor Operations for O'Neill Securities. Kenny, let's talk about catalysts and drivers for stocks. And I'm going to bring up a stock here, CMG, and I'm not asking for any comments on the stock, but perception. I mean, you've been in the markets. Yep. You've seen, once a stock gets a bad rap or a good rap, it's really, really hard to shake. So just regarding what's going on with CMG here, how perception, isn't that what, dominates movement in the stock?
Right, but we talking about the news that came out last week about the potential food issue again?
Yes.
Is that what you're talking about?
Yep.
Yeah, but okay, that's not even a perception. That was reality, right? There was another food issue with Chipotle, and so therefore, you wouldn't. I'm not surprised to see people back away from it, because this is not the first time this has happened. This is now the second time it's happened with them, and so it calls into question kind of a range of issues for the company in terms of quality control and and who's touching what and who's not playing, by the safety rules or whatever, however you want to define it. But yeah, once you get a bad rap like that, look, it's like being in high school. Remember, the kid who got the bad rap, right? It's hard to shake it. And so, you're going to look at those names, and then you have to decide, is that really, do you want to play in that space? Is that the name you want? If there's enough volatility in there, maybe as a trader, it makes sense to kind of flip it back and forth. But, as a long-term investor, you have to start asking yourself other questions. Is this more of a systemic problem? Is this a systemic problem with the way they run their business, or is it just once again kind of an isolated affair? I don't know the answer to that question. CMG is not one of the stocks I trade. Not because I don't trade. It's just not a name that I'm in, and it's not a name that I own. So therefore, I'm not paying that much attention to it.
Okay. Let's talk about real quick with the oil market, and I've seen so many calls here for $55, $60 oil. Just based on demand. That's my question. I've heard that from so many people, and I just look at from a technical standpoint. I'm like, man, you got a lot of selling to chew through, even to get to 50 to 55, 60. So oil stocks are trading okay on some of these earnings reports, but really, what's your overall look? Crude, it doesn't seem to be having the same negative effect it had on the market in early 2016.
Listen, there's no reason necessarily. Crude's trading what? It's up 40 cents today, so it's trading at 46 and change at the moment, 46, 15, 16, like that. But what's the real catalyst or reason for oil to go back to $55 or $60 a barrel? I'm just trying to understand myself because, A, OPEC is certainly not playing by the rules because we saw over the weekend or end of last week how their production net increased, and so somebody's cheating over there. Certainly the U.S. and the non-OPEC producers are now both at $50 a barrel, $45 a barrel. We can still produce oil and actually export oil because technology has changed the way that oil is produced and found and mined and refined and all that stuff. So it's cheaper for us to produce oil. It's cheaper for certainly the developed world to produce oil. So oil at a year and a half ago, the U.S. anything below $50 a barrel, we were losing money, and so therefore it became prohibitive. If it dropped below 50, we weren't producing. Now that number's more like 35. So at $46 a barrel, we're still making money, and so we're producing like gangbusters, as are some of the other non-OPEC producing nations. So really, why is oil going back to $55 or $60 a barrel right now? I don't see it. Besides the fact technology is changing the world, as we know, across the range of spaces, whether it's solar energy, whether it's battery-powered cars and all that stuff. And so the world is a different place, and it's going to be a different place. And even though there's plenty of demand for oil, there's also plenty of supply. And so therefore, I don't see the argument that oil is going back to $55 or $60 a barrel anytime soon.
All right, I'm on your side. And just before we let you go, of course, earnings are a driver, but the big driver is the Fed. The Fed's meeting this week. I'm still kind of trying to get my hands around.
What do you expect?
I don't know.
But what do you expect to hear from the Fed this week? Nothing, right? She's already made it very clear. I think this week is just going to be ho-hum, kind of a reiteration of what she said. We know that she's been very clear. She wants to start to shrink the balance sheet in September, and she wants to raise rates one more time this year. Now it looks like December is going to be the time frame. It's still unclear whether or not the shrink starts in September or not. I guess a lot of it's going to depend on some of the data over the next 5 or 6 weeks or 7 weeks that we see going into that September meeting. And a lot's going to happen, too. Listen, Mario Draghi came out last week and talked about the ECB, about their need to begin the tightening, although they're not tightening yet, so therefore there's still plenty of stimulation over in Europe. He's trying to prepare the world and the markets for a 2018 taper, although I'm not sure he's going to get there yet based on the GDP number and the growth number that came out of Europe this morning. It's falling, not rising, not a good sign. And the market data in the U.S. is weakening once again. I don't think it's crashing, but it's certainly not advancing. It's weakening, so she's going to have her hands tied, although she's backed herself into a corner. She's told everybody this is what she's going to do. So if she pulls away from that, that could be another catalyst for people saying, okay, it's not what she's been saying it is. And therefore, market valuations and market models will have to be repriced as a result.
Not only does this guy know the markets, but he's good in the kitchen, too, with his home-style cooking. Kenny, we didn't get a recipe today. Did you have a recipe today, or did you cook up something good over the weekend?
I did. It's pork cutlets wrapped in prosciutto and dressed in pine nuts, and you get it on my note. If you go to it's on Twitter, you can go to my website. You can see the whole note there as well. But, there's a recipe at the end of every note. So every day, not only do I talk about the markets, but I also give you something to eat. It could be pasta, fish, steak, veal, pork. Could be a range of things, so you can go there and find it. But today's recipe is actually a recipe that came from a friend of mine, and she got it from La Cucina, and it is absolutely spectacular, so you should try it.
You won't go hungry listening to Kenny Polcari, Director of New York Stock Floor Operations for O'Neill Securities. Kenny, it was great. It's been too long. We're going to get you back on again soon.
No worries. You guys have a good day.
All right. S&P's hit that unchanged mark, Dennis, and backed off just a little bit. So just real quick, Dennis, before we go into other issues that are moving today, just, I talk about unchanged a lot. I know you talk about unchanged a lot, especially, with earnings, but just talk about it a little bit as far as like your strategy. If you're buying a stock that's down to the day, or you're shorting one that's up of the day. I mean, is there any more important number than that closing tick?
No, because a lot of people are marked from that price. So obviously, we know institutions do a lot on the close as well. Closing is a big event. It's a big liquidity event where there's a big print going off. So there's a lot of people that are marked from that price. So it's also the price that shows up where it's going red on your screen or green on your screen for the day. So it's psychological as well. So when you get a stock opening down, like let's say $1, maybe it's got some bad news. When it comes up to that scratch spot, well, anybody who bought it the previous day, that's where they're breaking even. We know, a behavior from behavioral finance that there's a thing called loss aversion. People don't like to sell at losses. So they bought it the day before and it comes back to their price. that may be where they sell. And you just see a lot of times where a stock will be down on the day, come all the way back to scratch, and that's where it'll turn and start going south again. Or the opposite, a stock will be up $1 on the day, start turning south, and then come back to where it's flat on the day, and then actually start going up again. So it can be a good turning point, and that's why the close is very important to me too. And I know you've always focused on your numbers as well, Joel.
All right, if you came in long $1 million Hibbert Sports here, you're down $4 million on the opening print. So you just have to decide, whether you're sticking with this one. It's also, you get a movement in a stock like this, it affects other holdings in their portfolio that move the money around. So here we go. We got about 9 minutes left. Did we get through all the earnings?
We didn't.
We had a couple small ones there, but
we also missed SWK, right? Stanley Black and Decker. Are they a small one? I guess they're a small one.
No, I'll give it to us.
All right.
The numbers.
Q2 EPS of $2.01 versus $1.97. Sales of $3.23 versus $3.17 billion. They are also raising their guidance for the fiscal year. They see EPS at $7.18 to $7.38. That is an increase of 18 cents on the low end of the range.
And stock is down. Why? Because it's been going straight up into the report. We keep saying the same thing. Almost don't even need to know the numbers anymore. It's been a pretty easy earnings season to play on, because it's been the same story. Stock's been going straight up, have come out and just met or beat slightly, and they hit them. And there's been the odd time you get a Netflix that absolutely blows it away, but for the most part, it seems like 4 out of 5 times when the stock chart looks like this, it's down the next day on earnings. So here it is again, same story. SWK, decent report, not good enough because the stock's been up running into the quarter.
Boy, it's hard picking a level here on the downside. Pre-market low, 145.10, and basically you had a straight-up move from 144 to 148. I'll give you a low below that pre-market low of 45.10. See two lows between 44.46 and 44.86. So split that, call that 44.66. So we'll see what happens under 145 here. Below that, man, you get into a big green bar here. We know what happens when stocks go up quickly through an area. They'll also come down quickly through an area. So if you're really holding out, 142, you had a little double bottom there before you ran up to 148.32. So some potential downside here in Stanley Works.
Stock that's wild here this morning. Already traded 285,000 shares. Pandora Media, symbol P, is back up. It's a double-digit stock again. It's back up over $10. Got multiple headlines here. Jana taking a stake, and then also I believe Spotify is close to a licensing pact or something. But the Jana stake probably giving it a lift here. Do you see any other headlines I'm missing there, Spencer?
Yeah, the Spotify thing was a stake with Warner Brothers, I believe, but the Jana stake is the big news. They revealed in their latest letter that they did take a position in Pandora. So
you get these big activist funds there like a Jana, and that will lift the stock, and that's what we're seeing here. It's up 6% here in the pre-market. Got some levels for us, Joel?
Double digits is really important for this. See if you can close over $10. Pre-market high, $10.33. Haven't been over $10 since there was some rumors that it was getting taken over at $8, and that took it right back down. If you could keep going in this $10 handle, 4 highs right at the 1080 level, but I don't know. I'm skeptical. Big pop here off taking stakes. Close over 10 would certainly be important. A breakout over 11 would be even more impressive.
They're talking about Snap and the lockout. The lockup is this Saturday, the expiring of the lockup.
That's correct. The first one.
And okay, that's the first one only. So Snap's been straight down. We've been talking about it here. I wonder if you don't even. Sometimes what I actually get is people sell the hell ahead of that, and then actually you see it go the other way after the lockup. We see it sometimes happen where it just gets crowded. People are so short the stock or so bearish the stock that it actually can go the other way. I mean, the stock has been killed. We've been from 18 down into the low 14s here now over the course of the last 2 weeks. So I wonder if a lot of this isn't already priced in. You see an Apron get a little bit of a lift here this morning. Maybe it continues, and I think, long run, I still think this stock could be a single-digit stock. I'm just saying, I don't know if I'm coming here shorting it today. I think it's a little bit late to the party. I think the short was when it went through 18 and 7, or when it went through 17. And now, I don't know. I think you're kind of late to the party here. So I'm sitting just neutral here on Snap. Long term, don't like it though.
Yeah, kind of quiet here. 1434, that's the all-time low. That's Friday's low. All-time closing low, 1448. So just have to see if you get any interest here. I mean, don't get too fooled. You had a double bottom on Wednesday and Thursday at 1480, 1472. It did trade in the 15 handle, but ended up closing under 15. So really hard to find a really good level to lean on here in Snap.
Square made a new 52-week high again on Friday. SQ taking out the 27 handle up to 27.11. This stock, we've been talking about Twitter, how well that's been over the last bit. But this Square, Dorsey's other company here, this has been a monster. I mean, this thing back in July, so go back a year ago, it was $8. So it's went to 26 now. So you're talking about a stock that is up over 200% here in the course of the last year. What do you think, Joel? It's new all-time highs here for Square too, SQ.
Do you use it at all? Spencer, you're a young kid. Do you use that at all?
I haven't.
What exactly is it? Like, because me and Joel are old, and we don't know, like, how all this stuff works. Do we know what
it's a payment? It's a payment system. It's a way to pay for stuff. It's like an app, and you
like PayPal.
Sort of, yeah. But it's easy. It's like an app, and you just like swipe your phone over like the reader, and then it.
Okay. So that's what they're doing, like the cab sometimes, like when they take your MasterCard.
It's sort of like it's like Apple Pay. I don't know if you know what Apple Pay is. It's the same thing, pretty much.
I don't know what MasterCard Pay is.
It Visa. Boy, did I know Visa. Wave Trader's asking, what do we think about Google here ahead of the earnings? And boy, oh boy, I mean, earnings, if you're talking paying high premiums and high risk going into a report, that's what you have in Google. I'm taking a look, man. I'm looking at the Goog, no L here, and boy, that $1,000 level has been elusive. You had a couple highs right up just below it in the 980 handle. I mean, nice run up into it. I mean, you could get a good pop off the report, but who knows how they're going to treat it after a good report.
Yeah, it's, and Netflix had the gap and go. The report was good enough. Long term, I love Google. I own it in my investment account. It's one that I've had in there for a lot of years, and I've made a lot of money with Google there, and I'm sticking with it. So long term, I still believe if it's not, I think Apple's the most valuable company in the world. I think Google eventually is still the most valuable company in the world. They've just got everything figured out, very well-run company. I love Google long term. Short term, it's had a run-up. I mean, we've run from 900 to 980, so they need to blow it away. But this is a company that I wouldn't bet against because they can blow it away. So I'm, coming into this, event. It's Google earnings tonight here, saying, I don't know if I'd be buying it ahead of the report here, but I own it already and I'm sticking with it. I'm comfortable enough to stick with it through the report.
Real quickly, Downward Dog was asking, I believe it was him, asking about HD Supply Holdings Corporation here. Got a nice move off that low. I know you always like to pick bottoms there, and you did have a double bottom to lean on here at the $29 area. And now you're getting a rally going. But, man, just this 32.50 area just sticks out really on the daily chart. It's trading at 31.70. So today, if you run up there, it's probably going to exceed its average daily range if you do get up to 32.50. But just take a look at the four highs, 253, 241, 252, 253. That's the key to continued upside in HDS. All right, 9 o'clock, Spencer. You're going to stay on a little bit longer today, right?
I'm going to stay on a little longer today. And I've mentioned this a few times on the show now, but we have an event in September coming up on September 28th in San Francisco, the Benzinga FinTech Summit. And in preparation for that, I interviewed the co-CEO of one of the flagship sponsors of the event, Unison. You may have heard of them. They're sort of a home equity They provide home equity and equity for your home and for buyers or for sellers. And it's a pretty cool concept, I think. So I thought I would interview the CEO. First of all, basically what they do is they if you want access to a home, or you want to buy a home but you don't want to take on a mortgage, you can basically sell some equity in your home to Unison, and then they're backed by some institutional investors who can basically want long-term exposure to the real estate market, and it's the way they basically match investors with with home buyers. So this is an interview I did. It's about 10 minutes with Jim Riccitelli. He is the co-CEO of Unison. We are on the line with Jim Riccitelli. Jim is the co-CEO of Unison. Unison is a sponsor of the BZ Summit, the Benzinga FinTech Summit out in San Francisco on September 28th. Jim, thanks so much for joining us today.
Thank you for having me.
So I mentioned you're a sponsor for the BZ Summit, so we thought we'd get you on and explain a little bit about what Unison actually does, because it's to me at least, it's a pretty novel concept.
Sure. So Unison is a leading provider of home ownership investments. This is a new and revolutionary financial product category that addresses two huge consumer demands. Makes it easier to buy a house, and it allows existing homeowners to unlock a portion of their home equity without taking on more debt. Homeowners traditionally finance their homes with various forms of debt. With debt, you have interest and monthly payments. A home ownership investment is home financing based on a partnership, and it's not debt. It changes the game. We provide long-term investment capital to homeowner and home buyer clients. The client can use the money for up to 30 years. Unlike a debt-based program like a mortgage or a home equity loan, there are no interest charges or monthly payments to Unison. Instead, we earn a return by sharing the change in value of the home, up or down, when the homeowner decides to sell. Your audience can learn more about this by looking at our website, unison.com.
So, Jim, if I could jump in there for a minute. So essentially, it's sort of like the opposite of a mortgage. It's like a mortgage in that it's a way to access capital for a home, but it's sort of the opposite in that you're serving as an investor in the home along with the homeowner.
That's right. We don't become a co-owner of the home, but we are co-invested in the home. So we both will share in the change in value of the property. If it goes up, we make money together. And if it goes down, we lose money together.
And then, correct me if I'm wrong, but the main reason somebody would want to use a service like yours is just that. They want to get access to some capital for their home. Are there any other main reasons that people would want to use Unison?
Well, that's a big question, and I can give you a pretty big answer for that. So there are a couple of major challenges faced by home buyers. Let's cover that group first. It's hard to buy a home. There's a deeply declining home ownership rate, especially among first-timers and millennials. Over the past 10 years, overall home ownership rate in the U.S. has fallen from 69 to 63%, which is pretty much a 50-year low. And for Americans under 35 years old, the rate has decreased from 43% to 35%. There are a lot of factors driving this. You have stagnant wages in many regions. Home prices are rising faster than incomes, and rental rates are also rising faster than incomes. There's an enormous student debt burden. There's about $1.2 trillion of student debt spread across more than 40 million American families. It's not easy to income qualify for a mortgage loan. Standards are conservative, credit standards, and saving for a down payment can be very challenging. Families used to be able to help their children buy a home with a gift, and it's harder and harder for some families to do that. Low down payment loan products are available to some people, but these typically require mortgage insurance, which can be expensive. It increases the monthly payment and makes the income qualifying issue worse. And in some tight real estate markets, buyers looking to buy with a low down payment are competing against stronger offers, and they're sometimes disregarded by listing agents. So the Unison Home Buyer Program basically addresses all of that by doubling the buyer's down payment cash, which eliminates the need for mortgage insurance, lowers the monthly payment, typically by 15 to 20%. It can increase purchasing power by up to 100%. And so the buyer can choose and comfortably afford the home they really want, not settling for second best. This is a way for millennials and first-timers who have high rents and student debt to become homeowners, and it gives everyone greater choice over considerations like commuting, school district, home features. We also have clients that
actually have all the down payment cash in hand, and our investment in the property enables them to hold on to some of their cash for other purposes like college tuition, investing for retirement, or just to have something put aside for a rainy day.
I think it was a few weeks ago, you guys released a home affordability report where you kind of looked at home prices in major cities across the country, and some of it obviously keeping with what people expect it to be. The coasts are expensive. New York, San Francisco, we know this. But what can you tell us about home affordability sort of just across the U.S. as a whole over the past few years, and any other trends you're seeing?
Well, it's getting harder to buy for many people for a lot of the reasons that I just mentioned. And the purpose of our home affordability report was to really analyze this in some detail. So the idea was to look at a buyer's ability to buy when they have 10% to put down versus having 20% to put down. We look at the median income household in various metropolitan areas and compare those to buyer profiles, 10 down or 20 down. So I'll go into a couple of markets just to give you an idea of what the report shows. Let's start with Chicago, which in the U.S. is one of the more relatively affordable markets. So someone with 10% down in Chicago and is earning the median income in that area has maximum purchasing power of about $398,000 with 10% down. And with that purchasing power, they can afford 78% of the homes in that metro area. If they increase their down payment to 20%, they can increase their purchasing power to $477,000, and now they can afford 84% of the homes. So, it gives you about an 8% lift in terms of the housing stock that you can look at. But in certain neighborhoods, that extra 8% can make a very big difference in the ability to choose a home in the neighborhood. Now let's look at Seattle. Seattle's less affordable. In Seattle, with a 10% down payment, the median income household can afford only 38% of the homes. If you have 20% down, now that same household can afford 52% of the homes. So that's a very significant difference in the ability to choose homes and neighborhoods. Now let's take the opposite end of the spectrum, San Francisco, which is really expensive. Believe it or not, in San Francisco, with a 10% down payment, the median income household can only afford 1% of the homes. If you increase that down payment to 20%, you have a lot more purchasing power, but even still, you can afford only 3% of the homes. But that's a triple. So you can look at triple the number of homes, in San Francisco with 20% down versus 10% down if you are the median income household. And the report also zooms in a lot more specifically, not just metro areas. It can get into neighborhoods and age ranges. For example, in New York City, and let's be really specific, how about Flatbush, Brooklyn, right down to the 11210 zip code. Brooklyn's a pretty popular place. It's become popular with first-time buyers and renters and young people. It's got a great mix of high-rise condos and Victorians, townhomes, colonials, very demographically diverse mix of ages, ethnicities, and job types. But prices there have been rising to match the demand. So in that zip code, if you've got 10% to put down and you are in the median income and you're in the age group 25 to 44, you can only afford 160 homes, which is 2% of the total homes in that zip code. If you have 20% down, you can look at 1,150 homes, which is 15% of the total homes. So that's a very, very powerful increase in purchasing power. And it's a striking, information, to see about these different metros and how the median income families struggle.
Jim, how does that differ? I don't know if you know this, but how does that differ across demographics, right? First-time buyers versus maybe people who are, have young children or have been in the housing market for a decade. Is there a difference there? Millennials, Gen Xers?
It's really income dependent. But if you are a first-time buyer, if you're younger in your career, maybe your earning power is not quite what it might be later on. The problem is worse for you. If you've got multiple young children or older children going to college, the problem is worse for you because it's just another, it's another use of your income and leaving you with less income to afford a home.
So Unison comes in and through your programs you give people access to capital, but where do you get your capital from?
Our capital comes from pensions and endowments. These are institutional investors with important social mandates. We aggregate and manage thousands of these investments on behalf of these investors. They have a natural need for long-term price exposure to residential real estate, which is the largest asset class in the United States. And the asset class is very attractive to these investors because they have a long investment horizon and an objective of hedging or outperforming inflation. For years, there's been a scarcity of attractive investments for long liability inflation hedging investors. Residential real estate accounts for approximately 15% of U.S. GDP and comprises about 40% of the consumer price index. So it's a great inflation hedge, and these investors should have a large allocation in an institutional portfolio. But they've never owned any of this exposure because until now it wasn't possible for them to get it. And that's another game changer that Unison brings to the world. For the first time ever, the Unison programs make residential real estate the world's largest asset class, an investable asset class for institutional investors who represent the largest pool of investment capital in the world.
Any chance you can make that available to retail folks like myself?
So that's not our plan. We're not planning. These are the investment profile. I'm not sure retail would even work. Remember, the money we provide is 30 years, and the investor doesn't control the timing of when they would get liquidity for their investment. So I'm not sure that even if we were thinking of offering it retail, that it would make sense for the average retail investor. It's definitely a long-term, patient capital type of program. What we do make available to everybody, in addition to home buyers, we have another program that we call Unison Homeowner that's available to anyone who owns a home that's facing financing challenges. So there's a macro need to delever American consumers' balance sheets, right? Overall U.S. debt, I believe, is around $12.7 trillion at this point, which is, I think it's close to the all-time high or at it. A lot of this debt is high interest rate credit card debt, and that can be stifling to a struggling household. A lot of families address this spiraling debt by refinancing their mortgage or borrowing with a home equity line of credit to pay it down, and that can help. But you're just swapping more expensive debt for less expensive debt. You still have a monthly payment. And there are a lot of challenges for homeowners that want to unlock some of the equity in their home. In a lot of locations, home prices have recovered from the crisis, so there is actually home equity to tap into. But over the past several years, nearly every household has already refied into a low rate on their first mortgage. So doing a cash-out refi in the first mortgage would mean losing that low interest rate. That's not a great option. So to borrow against the home, they need to resort to a HELOC or a closed-end second, and those can have higher interest rates, and they're not as easy to qualify for as they might have been years ago. In addition, the baby boomer generation is retiring. You have about 10,000 boomers retiring per day. By 2030, the number of Americans 65 and over is expected to increase by 55%. And a lot of these folks are house rich and cash poor. A lot of them want to live in their existing home. They want to age in the home they love, and they need money to cover their living expenses. By 2030, unfunded retiree expenses are expected to total over $500 billion. So these elderly homeowners that are perhaps the most in need of unlocking some home equity typically have limited income and find it difficult to qualify for a home loan on a debt-to-income basis at all, any home loan. So the other option for them to unlock their home equity is to sell the home, and that's not desirable for them. So, again, we changed the game there by allowing them to get a lump sum financing from us to pay off their credit card debt or to use the cash for any other purpose they might have. And they can use the money for up to 30 years, and because there's no payment to Unison, no monthly payment, we're typically much more flexible than a lender when qualifying someone on a debt-to-income ratio. So that's our Unison homeowner program.
Huh. That's interesting. I wouldn't have thought of that, but it makes a lot of sense. And I imagine for some people, like you said, the people who are house rich and cash poor, it is desirable, and I imagine that's why you have the product. Again, we've been on the line with Jim Riccitelli. He's the co-CEO of Unison. They're sponsoring the Benzinga FinTech Summit. To learn more about that, you can go to bzsummit.com. Or to learn more about Unison, go to unison.com. It's unison.com. Jim, thanks so much for joining us today.
Thanks very much for having me. We love you guys.
All right, have a good one, Jim.
Take care.
All right, and that is the show for the day. So hope you enjoyed that little chat with Jim. Tune in tomorrow for our chat with Nick Shaheen. He's on the docket. You can catch our podcast on iTunes, SoundCloud, or Stitcher, or replay the show at Benzinga at youtube.com/Benzinga TV. Have a good rest of your day, folks, and we'll see you tomorrow.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.